Trade war concerns continue to remain. I think what's to be noted this morning is the fact that Apple is close to hitting the $1 trillion mark in market cap. And I think that will just change the dynamics of how companies are measured all over the world. But we'll keep it with the Fed's decision, which was status quo, pretty much on expected line. Priya Misra, head of global rate strategies at TD Securities, joins in with her perspective as well from New York. Priya, good to have you on the show. They played by the script, this morning as we talk about the Fed's decision. 2 more rate hikes is what they've signaled. But do you think the market is looking beyond and the dot plot is now focusing on what happens to the pace of hikes in 2019 and can the growth momentum sustain? Because the spread on the 2-year as well as the 10-year treasury yields is indicating an inverted curve, which just gives the market a sense that things may not be looking that great from front.
Sure. So, great question. I think the market is very comfortable with one more hike in September. So the September hike is almost entirely priced in. I think today's Fed statement sort of confirmed that, the market can handle one more hike. I think the question really is, even for next year, we're pricing in, 3 hikes between now and the end of next year. I think what the curve is telling you is that the market is very skeptical that the Fed can actually follow the dot plot, or that the Fed can hike all the way up to neutral and beyond. Because the dot plot suggests that the Fed's going to go to 3.5 by the end of 2020. And that's high. I mean, even if you believe the Fed's neutral rate of about 3%, this is arguing that the Fed's going to go 2 more hikes. And I think the market here is very skeptical. And if the Fed does continue to hike beyond neutral, I think a lot of us will start believing that the economy is going to show signs of slowdown, financial conditions will tighten, and therefore the curve flattening is consistent with that. So our view is, I think the economy looks very strong right now, but we're dealing with the sugar high of all of the tax cuts as well as the spending eases that happened. So that can last for another year. But after that, when we look at productivity, U.S. productivity is not moving higher. So long-term growth doesn't seem that much higher. So I think the market's a little bit calling the Fed's bluff here, that yes, you can hike 2-3 more times. And then I think the market expects the Fed to stop hiking, slow down. The Fed is being very careful not bringing up trade war, but that's a big concern. And if that starts showing up in investment spending, I think that'll be their excuse to slow down hikes beyond a few more. So the big concern, I think, for the stock market and the bond market is if they were indeed going to follow the dot plot. So, I think near-term hikes are fine. It's really that late 19, 20 that the market's very comfortable that there'll be no hikes. That's where I think the Fed surprise could come in, but I think it would be a policy mistake if they do go, according to the dot plot.
Priya, you've been looking at India as well closely. Would you say that the MPC yesterday was a little ahead of the curve in hiking rates by 25 bips?
If you look at the inflation backdrop, I guess you can see the argument. If you see what's happening with EM in general, I can see EM central banks being in a little bit of a tough spot here with just the start of the outflows. So, I think I would say that it looks a little early, but they are in a tough spot with inflation. I do think, they can't continue to hike because then, it's putting the economy at risk to some extent in an environment when dollar is anyway strengthening. So, I think EM in general, India is probably outperforming EM countries, but if the trade war thing exceeds, I think all EM central banks, India included, will need to slow down that pace of hikes because the growth momentum is going to start slowing.
Priya, closing comments. Right now everything is looking great. US economy is growing. Tariff war is important. Everyone is talking about it, but that is not in a sense having impact on the global growth patterns. You guess somewhere markets are getting very euphoric and they are not realizing that the reason why earnings and economy is looking strong is because of stimulus and tax cuts, and that is also coming after 8 or 9 years of recovery. So what is looking good right now may not look grand same time next year.
Yeah, I mean, this is the tricky part. And, certainly when I talk to investors, there's a wide-ranging of views from those who think this is just a sugar high and the moment the tax effect wears off, we'll go back to neutral, to those who do believe that, the administration is making America or making the world great through deregulation and through a lot of, tax reform aspects. I'm a little skeptical about these long-term effects, and I'm not sure deregulation right away improves productivity. There's structural changes ongoing, debt levels, income inequality. All of these things, I think, keep long-term growth low. So I think the reason we're sort of in this Goldilocks economy is every central bank is still extremely accommodative, at least among the developed world. I mean, look at the BOJ. They are barely, removing accommodation. ECB is being very accommodative. The Fed, even though they're hiking, is still well below neutral. I think that the tricky part for all markets will be when that normalization process reaches some sort of neutral level. And the Fed is ahead of that. So by the middle of next year, I think that's when the true test will come in. When the Fed gets to neutral and we don't see this surge in long-term growth, I wonder if that will be the moment of truth for the equity market, where some of that euphoria might subside, where, I think it's like, as they say, when the tide goes out is when you figure out who's swimming naked. That's the risk that I do worry about as central banks normalize.
Okay, Priya, appreciate and thank you for joining us. Okay,